What is the value of each share? 2 rupees. So 2 rupees. So that comes up to 8,000 into 2, it is 16,000. 6,000 worth of equity shares you are issuing. So for that, you are making use of the capital reduction account. To reconstruction account, 7,12,500 being reduction in the claims of equity shares. So you are reducing the face value from 50 rupees to 2 rupees 50 paisa. Hello everyone, I am Purnima, faculty in the Department of Commerce and Management, Vidhyaashram First Grade College, Temple of Excellence, MYSURU. I welcome you all to this session. In this session 4 of Unit 3, we will be working some more problems on capital reduction. Now this is problem 5. So let us see the problem here. The balance sheet of New India Limited as on 31/3/2021. 30,000 equity shares of rupees 10 each, 3 lakhs. 2,000 preference shares of rupees 100 each, 2 lakhs. Creditors 45,000. Preference dividend in arrears rupees 30,000. Total 5,45,000. Now on the asset side we have the goodwill. Goodwill is at 80,000. Buildings 90,000. Plant and machinery 1,25,000. Patents 60,000, preliminary expenses 20,000, profit and loss account 1,70,000, total 5,45,000. Now we have the additional information here. The directors propose to reduce the share capital and provide sufficient amount for the following purposes. So the directors have proposing to reduce the share capital and they are making use of that amount which is collected in the capital reduction account. So they are making use of for other purposes. To write off the profit and loss account debit balance and goodwill. Now what does this profit and loss account debit balance denote? It denotes the losses of the company. So to write off the losses, they are making use of this capital reduction account. And to write down the value of machinery by 20,000 and patents by 30,000. So they are planning to write down the depreciation for patents and machinery, and any balance available by reduction of capital to be used to write down the value of building. So whatever is the remaining amount that they are making use to depreciate the building value. So we will see the scheme of reconstruction. So what is the scheme of reconstruction approved? What they are telling is for every 5 preference shares, 8% preference shares of rupees 100 each and 20 equity shares of rupees 2 are to be issued. So for every 5 preference shares, so for 5 preference shares, they are issuing 3 preference shares and 20 equity shares. 3 preference shares and 20 equity shares. So this we should make a note of. So for every 5 preference shares, they are giving 8% preference shares of rupees 100 each and 20 equity shares of rupees 2 each are to be issued. Then for every 10 accumulated arrears of dividend, 1 equity share of rupees 2 to be issued. So if there is an arrear of dividend, for every 10 rupees, they are issuing 1 equity share of rupees 2. For every 5 old equity shares of rupees 10 each, 3 new equity shares of rupees 2 to be issued. So for every 5 old equity shares, 3 new equity shares are to be issued. Give journal entries and prepare capital reduction account and prepare the reconstructed balance sheet. So let us see how to find the solution for this. Now first thing is we have to decide what is the number of shares to be issued here. See, for every 5 preference shares, 3 new preference shares you are giving. So first thing is we have to know how many preference shares are there. Now we are having how many preference shares here? 2,000 preference shares 30,000 equity shares are there. So we are, see here, so 2,000 preference shares for every 5. So our 2,000 divided by 5. How much will it be? 2,000 divided by 5 will be 400. So you will have 400 preference shares into 3. So this will be, for every 5 they are issuing 3. So that will be 400 into 3. How much it will be? 1,200 shares of rupees 100. So for every 5 preference shares, 3 new preference shares are being issued. So for that will be 2,000 divided by 5, it comes up to 400 shares. So 400 into 3. So that will be 1,200 shares of rupees 100 each. So it is 1,20,000. So for 5 preference shares, again 20 new equity shares they are giving. So for every 5, again 400 into 20. So it comes up to 400 into 20 is 8,000 shares of rupees 2 each. So each and every sentence you have to analyze step by step and then calculate here. So 400 into 20, it is 8,000 in, and what is the value of each share? 2 rupees. So 2 rupees. So that comes up to 8,000 into 2, it is 16,000. Then next one is arrears of dividend settled by the issue of equity shares. So for every rupees 10 arrears, 1 equity share. So what is the arrear here? So let us see. What is the arrears? So they have an arrear of 30,000. So 30,000 is the arrears. So we have 30,000 divided by 10. So that comes up to 3,000. See, for every rupees 10 arrears, 1 equity share. So that will be 3,000 equity shares. 3,000 equity shares into 2. So that comes up to 6,000. Then 5 equity shares, 3 new equity shares. So for 5 equity shares. So if you can see here in the balance sheet, how many equity shares are there? 30,000 equity shares. So out of that, they have told for old equity. So 30,000 divided by 5, that comes up to 6,000. So for the 6,000 equity shareholders into 3, it comes up to 18,000 shares of rupees 2. So that will be rupees 36,000. So for every 5 old equity shares means starting in the balance sheet, how many equity shares are there? That divided by 5, so you get 6,000. So that into 3. So for every 5, they are giving 3 new equity shares. So 6,000 into 3, 18,000 shares of rupees 2. So that comes up to 36,000. Then arrears of preference dividend is given as an information like a contingent liability. When such arrears are paid, it is a loss to the company and hence debited to capital reduction account. So arrears of preference dividend, so it is a contingent liability. So that is why we have to write off the losses. Now we will write the journal entries for this. So first step will be the reduction of preference capital. So preference share capital account debtor. So how many preference shares we have? 2,000 into 10, that comes up to 2 lakhs. Then we have the 8% preference shares, 1,20,000. Then we have the equity share capital 16,000. To reconstruction account 64,000. Now, so this is the capital reduction, being new preference and equity shares issued and to the old preference shareholders. So the old preference shareholders are there. So we are issuing in their place, we are issuing 8% preference shares. So 1,20,000 and equity share capital 16,000 and then reconstruction account, the rest of the balance goes to 64,000. So this will be the journal entry for reducing the preference capital. So there, the next one is capital reduction account debtor. You are issuing this for the arrears of dividend. If you can see here, so for this first one, for this first note, we have passed one journal entry. So for the old preference capital, new preference capital and new equity capital, for this we have done one entry. So this is the entry here. So here we have the preference share capital account debtor 2 lakhs, to 8% preference share capital 1,20,000, to equity share capital 16,000, to reconstruction account 64,000. So whatever is the balance, it has been transferred to capital reduction account. Then being new preference and equity shares issued to old preference shareholders. Then now the next one is, if you can see the note here, the arrears of dividends settled by the issue of equity shares. So arrears, how much you are issuing? You are issuing 6,000 worth of equity shares. So it will be, so 6,000 worth of equity shares you are issuing. So for that you are making use of the capital reduction account. So this is a liability which has to be paid by the company, and as such the capital reduction account will be utilized. So capital reduction account debtor 6,000, to new equity share capital account 6,000, being arrears of preference dividend settled by issue of equity shares. Now the next one is equity share. So you are reducing the equity share. So equity share capital account debtor 3 lakhs, to new equity share capital 36,000 and to reconstruction account 2,64,000. So being issue of new equity shares at rupees 2 each. So the equity shares have been reduced to capital of only 36,000 and rest of the amount it is going for capital reduction. Then the next entry will be the reconstruction account. Now what is the amount in reconstruction account? How do you calculate? So you just add all the balances. So the reconstruction account balance is 2,64,000 here, and then here again we have 64,000 plus 64,000, so it comes up to 3,28,000, and then from this, so we have to reduce 6,000. So 6,000 we have issued here. So that will come up to, so we are reducing the 6,000 of arrears. So we have a balance of 3,20,000. Then from this 3,20,000, I am writing off the goodwill. You can see in the balance sheet here. So what is the value of goodwill here? 80,000. Then patent 60,000, preliminary expenses and profit and loss account. So you write off the value of goodwill 80,000, profit and loss account 1,70,000, preliminary expenses 20,000, machinery account 30,000. The balance I am using it to write off the buildings, being the above assets and losses written off. So whatever is the money collected in the reconstruction account, I am making use it of to write off the losses of the company. So in this way we have to write off the losses, and then we have the reconstruction account here. So in the reconstruction account, 6,000 is made use of to pay off the arrears of preference dividend. Then to profit and loss account 1,70,000, to goodwill 80,000, to preliminary expenses 20,000, to machinery 20,000, to patents, to buildings. So it comes up to 3,28,000. So here preference share capital 64,000 by equity share capital 64,000. The total comes up to 3,28,000. Then next we have the reconstructed balance sheet. So we have the equity 1200 preference shares of rupees 100 each. So that comes up to 1,20,000. So how we got 1200 preference shares? So you should make a note here. So for every 5 preference shares, so how many shares you are using here? 1200 preference shares. So that is what we are writing in the balance sheet. And then, see if you can see here, 1200 preference shares of rupees 100 each, 1,20,000. And then for equity shares, there are 29,000 equity shares. You can see here. So how many equity shares you are issuing here? Here we are having 8,000 equity shares. So 8,000 plus again here we have 3,000. 8,000 plus 3,000 plus again we are having here 18,000. So again 18,000. 8 plus 8, 16, 17, 18, 19. So 19, 29,000. So in the balance sheet, I will write 29,000 equity shares of rupees 2 each, 58,000. Next, creditors 45,000. So the total comes up to 2,23,000. Now here we have to make write off the buildings. So buildings value is 90,000. So 90,000 minus 2,000, it is 88,000. Then plant and machinery 1,25,000 minus 20,000, 1,05,000. Patents 30,000, 60,000 minus 30,000, 30,000. So the total comes up to 2,23,000. So we have one more problem here. The next problem, the following is the balance sheet of Hindustan Lever Limited before reconstruction. So let us see here. The share capital 12,000, 7% preference shares of rupees 5 each, 6 lakhs. 15,000 equity shares of rupees 50 each, 7,50,000. Loan amount is 5,73,000. Creditors 45,000. Sundry creditors, here we have 2,07,000 and liabilities we have 35,000. Total is 21,65,000. So buildings 4 lakhs, plant 2,68,000, trademark 3,18,000, stock 4 lakhs, debtors 3,28,000, 11,000, 4,40,000, total comes up to 21,65,000. The company is short of working capital and a scheme of reconstruction has been approved by both the classes of shareholders and sanctioned by the court. So what is the scheme here? The equity shareholders have agreed that the rupees 50 share be reduced to rupees 2 rupees 50 paisa per share. So 50 rupees share is reduced to 2 rupees 50 paisa. They have agreed to subscribe in cash for 3 new equity shares of 2 rupees 50 paisa each. The preference shareholders have agreed to cancel the arrears of dividend except 4 new preference shares of rupees 10 each for every preference share they held and buy 6 new equity shares of rupees 2 rupees 50 each fully paid. Then the loan creditors of rupees 1,50,000 have agreed to convert the loan into preference shares of rupees 10 each and 12,000 new equity shares of rupees 2 rupees 50 paisa each. Then the directors have agreed to subscribe in cash for additional 40,000 new equity shares of rupees 2 rupees 50 paisa each. Of the cash received by the issue of new shares, rupees 2 lakhs is to be used to reduce the loans due by the company. The amount available is to be applied to write off the preliminary expenses, profit and loss account, and to write off the plant and machinery by 35,000, and the balance to be used to write off the value of trademarks and goodwill. Show the journal entries, prepare the balance sheet of the reconstruction. So we will have to write the journal entries here. So first thing is we have to see what is the scheme of reconstruction here. So the equity shareholders have agreed that the 50 rupees share to be reduced to 2 rupees 50 paisa per share. Now if you can see here, how many equity shares are there? 15,000 equity shares are there. So 15,000 into 50. How much it is? Into 50 is 7,50,000. Now, they are reducing it to 2 rupees 50 paisa. 2 rupees 50 paisa. That means from each share, 47 rupees 50 paisa is going to capital reduction account. So if you can see here, so 7,500 into, so this is the original capital, this is the old capital. So 7,50,000. 7,50,000 is the old capital here, but then being reduction in the claims of equity shares. So you are reducing the face value from 50 rupees to 2 rupees 50 paisa. So the value of from each share, they are taking 47 rupees 50 paisa to the reconstruction account. So that will be 15,000 into 2.5. So that will be the value here, being reduction in the claims of the equity shares. Then bank account debtor 1,12,500. So if you can see here, the scheme of reconstruction, they have agreed to subscribe in cash for 3 new equity shares of rupees 2 rupees 50 each. So it will be being issue of 3 new equity shares to the shareholders, 3 shares for each share. So how many shares are there? 15,000 shares into 3. That will be equal to 45,000. So 45,000 into 2 rupees 50 paisa. So if you can see here, they have agreed to subscribe 3 new equity shares for 2 rupees 50 paisa each. So 15,000 into 3 will be 45,000 into 2.5. So that will be 1,12,500. 2 equity share capital 1,12,500 being issue of new equity shares to the existing shareholders. Then the next one is now the preference capital. If you can see here, the preference capital in the balance sheet, it is 6 lakhs. So for 12,000 into 50, it comes up to 6 lakhs. Now the preference shareholders have agreed to cancel the arrears of dividend and to accept 4 new 5% preference shares of rupees 10 each for every preference share they held, and to buy 6 new equity shares of 2 rupees 50 paisa each. Now, if you can see here, how many preference shares are there? 12,000. So 12,000 preference shareholders are there. Now, they have agreed to cancel the arrears of dividend and to accept 4 new preference shares of rupees 10 each. So, for this, each of them, they are telling they are ready to accept 4 new preference shares. New preference shares of rupees 10 each, and to buy 6 new equity shares. Again, 6 equity shares of 2 rupees 50 each, fully paid. So we have to calculate here. So 7% preference shares, the entire share capital I am debiting here. Now they are being issued 4 new equity shares of rupees 10 each. So it will be 12,000 into 4. So there are 12,000 preference shares, into 4 it comes up to 4,48,000 into 10, that is 4,80,000. So the difference amount goes to capital reduction account 1,20,000, being conversion of existing preference shares into shares of rupees 10 each. Then next, they have also agreed to buy 6 equity shares to the preference shareholders. So bank account debtor 1,80,000, to equity share capital 1,80,000. So if you can see here, and to buy 6 new equity shares of 2 rupees 50 each. So each preference shareholder is buying 6 new equity shares. So that will be 12,000 into 6. That is 72,000 into 2 rupees 50 paisa. So that will be 72,000 into 2 rupees 50 paisa. So that will be 1,80,000 and 2 equity share capital 1,80,000 being issue of 6 equity shares to the preference shareholders. Then next, the loan creditors account. So the loan creditors 1,50,000. So they are being paid preference capital of 1,20,000 and equity share capital of 30,000. So the loan is being converted into shares. Being part of loan converted into shares. Then next one is bank account debtor 1 lakh to equity share capital 1 lakh. So here if you can see the adjustment here, the directors have agreed to subscribe in cash for additional 40,000 new equity shares of ₹2 rupees 50 each. So 40,000 into 2.50. So that will be equal to 1 lakh. So that entry I am writing it here. So bank account debtor 1 lakh to equity share capital 1 lakh being issue of new equity shares to the directors. Then next one is loan account debtor 2 lakhs to bank account 2 lakhs being payment of loan in cash. So whatever loan was there in the balance sheet that they have paid off. Now the capital reduction account, so 8,32,500. So all the money whatever they have collected here. So here there is 1,20,000, then 7,12,500. So totally it comes up to 8,32,000. So you are writing off the preliminary expenses 11,000, to profit and loss account 4,40,000, to plant and machinery 35,000, to trademark and goodwill, and whatever is the difference amount, it is going to 28,500, that is being credited to the capital reserve account, being the various fictitious assets and other assets written off. So we have written off all the fictitious assets and other assets with the help of the capital reduction account balance. Then now we have the new balance sheet of Hindustan Limited. So totally we have 1,84,000 equity shares of ₹2 rupees 50 each. So how we got this 1 lakh? That we have to add all the equity shares whatever we have issued here. So if you can see here, so we have issued 40,000 equity shares to the directors, and we have also issued some equity shares to the loan, and then we have again existing equity shareholders we have issued. So all this when you add together, you will get 1,84,000 equity shares of ₹2 rupees 50 paisa each, that is 4,60,000. Then 60,000 5% preference shares. So again preference shares, we have given extra preference shares to the existing preference shareholders. So that comes up to 6 lakhs. Then loan amount. So 5,73,000 minus 3,50,000. So that is 2,23,000. So loan amount you are paying 2 lakhs. So whatever the money you have got from the issue of equity shares, out of that 2 lakhs you have paid off the loan. So capital reserve is 28,000. Sundry creditors 2,07,000. Other liabilities is 35,000. They remain the same. The total comes up to 15,53,500. Now in the asset side we have the buildings. We have the building value, it remains unchanged. Now the plant value, it is 2,33,000. We'll see what is the written off amount, 35,000 here. So if you can see in the old balance sheet, what is the plant value? 2,68,000. Out of this you are reducing 35,000. So the balance becomes 2,33,000. Then trademark and goodwill gets cancelled. This is not there, this is not there. So we have plant value 2,33,000, stock 4 lakhs, debtors 3,28,000. So we don't have profit and loss account, we don't have the goodwill and trademark. They are all written off. So the bank balance is, so 1,12,500 plus 18,000. So all the debit balances of bank you add together, and this is the loan amount which we have paid. So the balance amount is 1,92,500. The total comes up to 15,53,500. With this, we come to the end of this session. Hope you have all followed it. Thank you.